Despite seeing a bout of volatility, the Nifty and the Sensex ended with gains of over 2% for the week. The mid-caps outperformed frontline indices this week, ending over 4% higher. On Editors Roundtable today, we'll discuss if the worst is behind for the chemical space. We'll also do a deep dive into CG Power's success story. That's not all. We'll also take a look at all of the stocks in focus due to India's manufacturing push and lots of big, news that took place in the week gone by. I'm Sonia. With me, there's Prashant, Anuj, Nimesh, and today we have a special guest in our studio. There's Kenneth Andrade, the founder and CEO of Old Bridge Capital Management. Kenneth, thank you so much for joining us. But folks, it's been an interesting week, right? One up day, one down day, but by the end of the week, the market managed to stay above that 22,000 mark.
Absolutely. I think, Sonia, this week was very interesting technically because the market had signs of some kind of breakdown in between, but then especially from the 20-day exponential moving average, which is very crucial level. And then the kind of bounce that we had yesterday on the expiry day, and that sort of continued today. And keep in mind, the market's trading tomorrow as well. So in that sense, it's been a good week. It's still not over, of course. But yeah, I think all the boxes were checked as far as the bulls are concerned.
Towards the end, actually, there was a little bit of interest which came in, right? Otherwise, every day you wake up, the market opens 50 points higher, and by close, you're down 100, 200 points. And this especially when US markets have been doing well.
Exactly.
You know, the rates in the US have repriced aggressively lower.
Correct.
Dollar is down to 104, 105 or so dollar index. But we're starting to respond, correct some of that underperformance.
I think the overarching theme is whether the current government comes back to power with a thumping majority or not, right? That's been a little bit on the market's mind.
Absolutely. I tell you, in fact, I'll go through what actually happened this week, Sonia, and in that I think I'll point that out as well. This was a week of stock parties, so much that, market's trading tomorrow as well because we want to have one more day of party. Of course, tomorrow, keep in mind, all the stocks will have maximum 5% circuit, even if you are FNO stocks. The mid-cap index was up 4% this week. The small-cap index was up 5%. But within that, look at what happened. Realty index up 7%. Metals index up 7%. Capital goods up 8%. And earnings reactions were extremely volatile. M&M rallied 15% this week. Bulk of it actually happened post-earnings. Tata Motors, on the other hand, was down 10%. The other big talking point this week was really the return of PLI stocks, EMS stocks, the way today, stocks like Dixon and Keynes rallied, despite not so spectacular numbers. What's that telling you? That is telling you that till last week, the market's fear was whether the BJP or NDA is coming back or not. I think the market is now pretty sanguine about that. I think that this week, that question got more or less answered in terms of what the market believes. Right or wrong, we'll know on the 4th June. But I think at least the risk factor that was opening up, I think that's now slowly but surely disappearing from the table. That's my sense.
The other big trend for this week was the return of the manufacturing stocks. Like a lot of capital goods stocks were buzzing. And one of the reasons explained was that maybe the new NFO money is getting deployed. Nobody knows whether they've put in any money, but the stocks are up 10-15% and on large volumes as well. So looks like the retailers have partied earlier than what even the fund would have started participating. But that was one big sector which has seen a big outperformance on just an hope that the new NFO money will just get deployed very fast and very sharply into this capital goods stock.
Actually, let's bring Kenneth into the picture. Kenneth, what's your sense? You've seen so many market cycles. We all know that the election result impact is there for a month or so. After that, the market just moves on. But what's been your sense this time?
I must say, corporate earnings are much stronger than people anticipated, right? And over a broad spectrum, the macros look absolutely good because, simply put together, India is running out of capacity. So the much talked about private capex that we were talking about, I think that's around the anvil. And the credit growth that will go to manufacturing, I think you'll see that coming through in 2025 and 26, and that will be the first year of that happening. I think that all optimism is boiling down to what's happening with capital goods at this point in time.
I think back in 2021, I'd met Kenneth and he was running some numbers on Excel and exactly what we were talking about. Her capacity utilization is going to come to a level where you need to start to put up capacity. And I think on the industrial side, as Nimesh said, they're all adding capacity. But on elections, as Anuj said, let me frame that question differently. Fair to say markets, their collective wisdom, right? And how they go into the election, they'll get the verdict right? There is the odd 2004, but that's once in a while. Otherwise, they usually get it right.
You get it a number of times. I mean, I've been stopped out on volatility both ends. Over-invested at points and under-invested at points in time. So you get it at both ends. So that volatility is going to be in continuation at least for the first couple of
No, but the broad
months.
direction that gets right. That's what I'm saying. I mean, if you...
I mean, from an economic standpoint, there's so much of tailwinds that there's so much of momentum within the entire economy that's going to move right now. Whether it's a thumping majority or whether it's a majority, I don't think that's going to be that's going to change the situation quite dramatically there.
But is it like a situation where the market is just waiting for this event to move out of the way and then sort of chug along on the upside? Is that a good way to look at it?
Any environment or any large event, the market will wait for it to get out of the way. It will trade in a particular direction, and that's what's happening.
So if this uptrend is intact, right, just assume whatever the outcome of the election, if the uptrend is intact and we resume the uptrend post-elections, then do you what are the spaces that you think where still there is some valuation headroom?
That's a difficult one. Okay, because I mean, let me break it down into a number of segments of the market that is there, right? First, you take capital goods, right? We had a brilliant run last entire month or last entire quarter. Now, the strange part of that, or every market throws out different statistics. This market's thrown out quantitatively a very different set of numbers. If you take all the large MNCs that are trading in India, right? If you take the bearing guys, all the bearing companies, they are trading close to between 20% and 30% of their global market capitalization. All of it is sitting in India. Right?
You mean the global market, 20% of the global market cap is trading here?
Yes, yes, yes. And if you, there was, I mean, except for one company in India where the domestic market cap is bigger than the global market cap is Maruti.
So there's Timken, there's Schaeffler, there is SKF, right?
Yeah. So Timken and SKF is almost 30% to 40% of their global market capitalization. I mean, even larger companies like ABB, you already hit that number. Yeah. Okay. So like in any expectation of a momentum-driven environment, stock prices always represent the momentum first. Earnings have to be back-ended.
Correct, correct.
I think that's what's happening as far as one segment of the marketplace is concerned. Now, everything that was there in momentum in say, the private banks at the end of the last decade.
1 minute, let me just complete that point. Are you saying 20-30% is kind of a ceiling? Is there a takeaway from that?
There's no takeaway from that, but those businesses are significantly larger and have all the technology with them.
Okay.
Okay, and they trade between 10 times and 15 times multiple at the global cycle. So if I complicate this argument a little bit, and if I take the terminal value of these businesses trading at 10 to 15 times multiple, I think a lot, these companies have to do a lot to justify where they are standing today.
Okay.
Maybe, Prashant, that explains why Timken Global had to sell 24% in Timken India. And he explained, right, it was an arbitrage trade between the global company and the Indian company. So that's pretty much...
That was, I think, Whirlpool. But it's the same kind of...
It's the same kind of thing.
Large transaction happened.
So in the previous cycle, you had Whirlpool and the domestic appliances.
But the takeaway is that it's pricing in a lot. That's a takeaway.
It's pricing in quite a bit.
Okay. Well, there's a big theme that we're tracking, right? And Nimesh is going to talk about that, which is the chemical space. There have been some brokerage upgrades on some stocks, but the key question that we're asking is, what is the future trajectory of the chemical stocks? Nimesh, you have some details that you fished out for us?
Well, Sonia, the key reason I'm putting this out is because most of the chemical companies' results are out, and the big question or the debate in the minds of the investor is the worst over for the chemical sector. So let me just go to the wall and put some data and explain as to why I'm saying this. So the big question that we're asking is the worst over for the chemical sector? Is the worst behind? Now, there has been few brokerage reports in the last few days where they've turned a bit bullish on the chemical sector. But if you look at the management commentary post Q4, most of the managements do believe, and they have a mixed feedback, and they expect the recovery to be in the second half of FY25. And even when there is a recovery, it's going to be volume-led and not price action. So the margins could still be under pressure even in the second half of FY25. That's a management commentary. But look at the chemical as a space. There has been short-term pain for the chemical sector stocks, but over a longer-term period, they've been massive wealth creators. The next table will show you what I'm saying. Over the last 2 years, most of the chemical stocks have been under pressure. Aarti is down 12%, Atul is down 28%, Navin Fluorine is down 14%, and so is Vinati down 12%. But over a 10-year period, they've been massive wealth creators. Same is with UPL. The stock is down 35% in the last 2 years, but it's gained 15%. But there has been some notable winners as well in the last 2 years. PI Industries has been the best performing chemical stock over the 2-year period, up 54%, despite the fact that it's been a 30% CAGR over the last 10 years. Deepak is up 25. Again, that's a big wealth creator. So is Tata Chemicals and SRF marginally up in the last 2 years, but there's been a big recovery over a 10-year period. But look at the valuations now. The 1-year picture, 1-year forward earnings will show up for you. SRF is trading at close to 37 times. PI is trading at close to 30 times. UPL is trading at close to 19 times versus 5-year average of just 12.5 times. Deepak is at 32 times. And so is Tata Chemical trading at close to 27 times on 1-year forward. Even if you look at the other names like Aarti, Atul, Naveen and Vinnati, all are trading between 35 to 45 times on a 1-year forward. So earnings-wise, so in terms of valuations, they're still not very cheap. Purely going by the valuations, looking to the 10-year averages. But as I said, some of the brokerages have turned positive on the chemical sector. UBS put out a note on the chemical sector. They say that the investors may be ignoring some strong niche positions and growth opportunities within the sector. They are seeing some modest volume recovery for many of these companies, and hence they initiated a buy report on PI Industries as well as on Naveen Flooring. Interestingly, even Morgan Stanley put out a note on Deepak Nitrate a few weeks back, and they've actually double upgraded the stock to overweight now. They have a target price of close to 3,000. They see a potential 20-25% upside from here. But the key is that they believe that the earnings can double for this particular company by the next 4 years. So it's been a mixed feedback from a lot of analysts. But from a long-term perspective, chemical companies in India have been big wealth creators. So the question is, are we close to the bottom? If Kenneth, you can have if your views on whether the chemicals is the worst behind for them.
The worst might be behind for them. Okay, the pricing pressure that was there in the segment, it's moderated quite significantly. So obviously you've got to stabilize here first, build an entire base, get your volumes back, go and mine more customers, and then just wait for a recovery. Yeah. I mean, key to all of this is what kind of capital investment has gone in this entire segment, and all of that will start coming on stream over the next 2, 3, 4 years, and that's, I think, will what's contribute to it all. So the huge optimism probably is off the table. There's a little bit of hope creeping in because a lot of these companies have not done too much over the last couple of years. But I think the big upside that we've seen in the past 10 years, it may not be replicable. Okay. So I'm a great believer of reversal to mean, right? And these valuations necessarily have to correct. Okay, businesses have to consolidate themselves. Balance sheets have to get into place, and then they have to optimize capacity. So I'm not too sure about 2025, but maybe in a year or two you will definitely see this segment recovering.
Just to sort of carry on Sonia's question to you, where are the opportunities? We started talking about the capital goods and the bearing companies, but identify 2 or 3 spots for us. Where are you putting money to work?
You see, when the entire world is in this large capex explosion, right? There are 2 segments that is driving capex globally. One is obviously defense. You take any part of the world, any country that is out there, including us, the focus on defense is up there. The second one is power and the shift into new energy, and that's driving the second large leg of capex. So if you put these both together, okay, all of this is capital intensive. All of this is it needs capital. It's hugely capital intensive, and more or less it's very commodity intensive. So what we don't have in India is a lot of these mining businesses that are directly listed, or most of them are owned by the government. So at the baseline, our preference is largely commodities. Okay. I think that's where valuations are reasonable, not cheap. That's where the balance sheet structure, okay, is completely different from what it was in the last decade. I mean, just steel companies have doubled domestic capacity and halved their debt on book. Okay, and that's a space that I think it does offer a reasonable amount of comfort, volume growth, and more importantly, the pricing of this product that is there, or any commodity pricing that is there, is somewhere at the averages of the last decade. So you're not even sitting at an all-time high in terms of prices of commodity prices out there. So I think that's where our preferences are consolidating around at this point in time.
So steel, basically. I mean,
It's,
if one has
it's
to...
steel, it's
Mining.
aluminium, it's zinc,
Commodities.
it's you put it all together, whatever you can get your hand on in India.
But it's not the defense of the power companies. That's, I mean, direct place. That's not the...
I think I'm not too sure there's a way to price any of these. Everything is like 6 times and 7 times price to book.
Yeah.
Or rather, should I put it differently? It's not in our comfort zone.
Okay.
It's not in our
Fair
comfort
enough.
zone.
That's a good way to put it. But let's talk about CG Power now, because investors have received over 20 times returns from the stock in the last 3 years. Prashant, tell us more about the growth trajectory of CG Power.
Sonia, it's just a sort of softish feature piece, but I think it makes sense because, you know, incredible what the Murugappa group has been able to do with CG Power. So let me just actually go across and explain what has happened. And the reason why I'm doing this today of all days is because it's hit a 1 lakh crore market capitalization, right? That is just incredible. Now, it is obviously not just one thing. It's many things which has contributed to this. It's not just the sort of leadership of the Murugappa group and the person in charge, which we'll get to in just a bit. It's, of course, also the fact that, you know, the businesses it operates in has had a huge tailwind. Transformers, switch gears. I mean, the space has boomed. And, of course, the company has taken advantage of it in a very big way. So, a lakh crore in market capitalization. But let's just quickly tell you a brief history of the company. And, you know, we'll start in 1878, about 150 years ago, and end up in 2024. So, you know, it was actually founded as a business in 1878. So that's how old the company is. Just a few milestones, really. You know, was taken over by the Thapars, the founder of the present-day Thapar Group, Mr. Karamchand Thapar. That was in 1947. In 1966, you know, the CG Power as a business, as an entity came into being. Between 1960 and 2005, I mean, basically it used to do motors. Then it bought into transformer technology. It forayed into switch gear, etc., etc. So this is that 40-year period. Between 2005 2012, I mean, the company started actually spreading its wings outside of the country, outside of India. It actually bought 5-6 companies. It started with that, you know, Belgian-based Powell's Group, which it acquired, and of course later over the years it also started selling a lot of these companies. In 2016, there was a demerger of the Consumer Products Division, which is the sort of, you know, Crumpton Consumer, the other name, which of course did very well this Friday. In 2019, then there was trouble, right? There were reports of unauthorized transactions, siphoning of funds. There was a forensic audit, a forensic auditor who was appointed, and of course NCLT stepped in, lenders sort of stepped in, and things went south very, very fast. And then in 2020, you know, Tube Investments, which is part of the Murugappa group, bought controlling stake. This happened on, I mean, the transaction finally was completed on the 26th of November 2020. So late that year, this is, of course, COVID time, and they infused, you know, 800 crores into the company to begin with. Now, that's the history, right, and how it all really began. I'll get to what the stock has done in just a bit. But, you know, the turnaround sort of person really here is the MD and CEO, Mr. Natarajan Srinivasan, who took over as MD and CEO in the depths of COVID in 2020. I mean, think about it. A company which is going through that kind of stress, you take over, there is a global pandemic going on, and you can't obviously do face-to-face meetings, and, you know, everything has got to be on Zoom. All of that stuff is happening in the background, and you're trying to engineer a revival of the company, right? Mr. Srinivasan, of course, is a corporate veteran, nearly 40 years of experience, started his career at BHEL, been with the Murugappa Group for 20 years, served as a director in Murugappa Corporate Board, and of course was also MD Cholamandalam Investments and Finance. So a pretty illustrious career overall. And, you know, what he's done, of course, him and of course his team has done is quite remarkable. Look at this. This is, you know, a quick snapshot. These are the latest numbers we have, right? FY20 is the last figure. Before, of course, ownership changed hands, and that is, I've taken one more year, so you don't see exactly the worst of the numbers, but you take 1 year before as well, when, you know, trouble really hit home hard. FY19, FY20, and if compared to FY24, I mean, you can see what's happened. Look at revenues, look at EBITDA, and look at adjusted profit loss, 850 crores in profits, as compared to, of course, I mean, the prior year sort of numbers are up on your screen. This is the stock price trajectory, right? All the way back from I've taken last 24 years, year 2000 to year 2024. And you tend to compare these figures from, the stock had gone down to $5 from 5 rupees, it's come to 600, 700 rupees. I'm not doing that. I'm just looking at where it was when the Murugappa Group took over. That was 25 rupees a share. From 25, of course, it's gone up to, at the high, of course, it hit almost 700 rupees and it's sort of closed slightly under it. Before the takeover and before there was none of this trouble with the Thapar group, with the Thapars who were the earlier owners, the high, of course, was about 100 rupees per share. So kind of even from that level, it's actually gone up about 6 times or so. So it's just absolutely been a stellar rally. What next for CG Power? That's, of course, the story. The management is confident of doubling the size of the existing business, both sales and profit after tax in the next 4 to 5 years. The existing businesses, of course, are switchgears, transformers, motors. They're expanding capacities across all of these categories, actually. And they're, of course, also foraying into the semiconductor testing space, the OSAT space, towards which they've actually committed some amount of money. So this is the story, right? 26 times from the 25 rupees in the last 3.5 years. And that's what sort of, stable leadership and turnarounds can look like. Any point from that 25 rupee journey you could have gotten in. And this is, of course, this would have been a big multi-bagger. Let me actually put this to Kenneth. Kenneth, your thoughts on CG Power. I don't know if you bought it at any of those points, but your thoughts now.
That's a difficult one. If you're asking me right now, you mentioned that it'll double turnover over the next 5 years.
Yeah.
And if it doubles profitably in the next 5 years at a 1 lakh crore market capitalization, you can do the numbers. Okay.
No, I'm actually more keen on Kenneth to know from you what could be the next CG Power. I know it's a cliche, and there is nothing called a next CG, but still.
CG Power, as they say, right? It could be. What are you saying that it could double? You could do the number. Or does it have to do that to justify the current market cap?
No, I'm saying neither. I'm saying that today the business reports about 1,000 crores of profitability. It trades at 1 lakh crores of market cap. So even if it doubles or goes up, it multiplies its profitability 3x over the next 5 years. It's 3,000 crores of profitability and 1 lakh crores of market cap.
Right.
So that works out to about 33 times earnings. Now you got to be comfortable with that, buying that stock 5 years forward in that format. So you can do the computation. Like I said some time back, this is not our style of investing. So probably stay away from what.
So now just to wrap it up, I know they're asking us to wrap up, but the next CG Power, one name, Kenneth, and we won't hold you to it. And just for educational purpose, what do you think?
So find an industry without pricing power, or is at the bottom end of pricing power. Find an industry that's paid back all its debt and is generating enormous amount of cash, which funds its expansion, and where valuations are reasonably comfortable and not at the reasonably comfortable, because in this marketplace it's very difficult to find anything at the bottom. We got a lot of pharmaceuticals. This is US facing pharma businesses. It represents a little bit of everything: gaining market share, low pricing in the business, a very large output, a very large we're going into a patent peak somewhere in the next 4 years, so market opportunity expands, and all of these companies are sitting with cash that can fund all their expansion that is required. I think that's where that's what's anchoring our entire portfolio at this point in time.
It's very bullish in pharma. I got the answer because I've seen his portfolio.
Okay, let's do one thing. Let's also talk about, one space that has had, and I wanted your thoughts on this as well. One space that has had a really strong move in the last couple of days and weeks, right? It's this whole manufacturing theme, India manufacturing for the globe. And I want to talk about it today because Dixon Tech was the big mover in this week. In case you missed out on it, a lot of Indian companies are getting a larger seat at the table when it comes to manufacturing for global peers, right? Dixon Tech is now up 35% this year. As we know, they manufacture modules, display modules for mobile phones, and now they're working with almost all the large global players, whether it's Xiaomi, Realme, Motorola, etc. A couple of days ago, the company told us that currently they're manufacturing 7 million display modules for smartphones annually. That could rise to 30 million in FY25 and 45 million by FY27. That's the kind of scope that they see. And they're also in talks with other large global mobile manufacturers. CLSA, in fact, raised the target price on Dixon Tech to 9,000 rupees. Now, other examples of Indian manufacturers, for global players include Exide, where they recently won a deal with Hyundai and Kia. Bharat Forge has also spoken about how they aspire to be a global artillery house, with 80% of their defense business being in the export space. So, Kenneth, you know, Motilal Oswal put out a note recently where they said that global manufacturing hub, India as a global manufacturing hub, is a big theme across sectors, whether it's semiconductors, electronics, automobile, EVs, aviation. But in this space, a lot of these stocks have run up already. Where do you still see some potential?
Whatever you do at this point in time, right? Any of these businesses, my sense is that you'll have to give it a time consolidation before you see the next up move. Because the prices represent a lot of earnings which is to come still.
Yeah.
So you still have to demonstrate your capabilities of generating profitability from whatever you're doing. And in an industry like this, when your capital employed or your investment is increasing at a very fast pace, the returns take some time to come through.
Yeah.
I'm undoubtedly, I've got no doubts that all of this are very large businesses, but you should have been in this space about 3 years back.
Yeah.
Okay.
Exactly.
So the way to think about manufacturing in India and chemicals came up, and I mentioned pharmaceuticals. This is also manufacturing. This has also got PLIs. This is also the space that it's in. So what's going to do well in 26, 27, 28? Okay, for the same segment of the market to do well in the next 3 years, there's got to be a dramatic change in execution now. Okay, there's got to be a dramatic change in execution.
So are you saying it's too late
else.
to get into something like a Dixon Tech if you missed out on the rally?
I'm not saying that. The expectation is I'll generate the same amount of return.
Yeah.
There's a difference in it. Okay, I'm not bearish on the opportunity. I'm probably a little apprehensive on the quantum of return that you can generate at this point in time. There's a difference between the two.
Okay, all right.
Okay.
Actually, we've run out of time, not out of questions. But thank you so much for joining us here in the studio. It was a pleasure. And of course, we have a very hectic weekend. We're trading tomorrow.
Working
tomorrow, and we're voting on Monday. Right?
And we are watching Manchester City win the title on Sunday.
Yeah. Well, don't jinx it, Anuj. But okay, with that, it's a wrap on this edition of Editors Roundtable. More news and updates continue right here on CNBC TV18.